How to turn debt into wealth is a little bit of a counterintuitive idea to ponder. And I acknowledge you for even showing interest in something like this. And it's probably because you heard that using debt to create wealth is how many, if not most of, the wealthiest people got wealthy. And you want to be wealthy. I like your style. So stay tuned. I'm going to show you exactly how it's done and how you too can pull it off, regardless of where you're starting from. You ready? Let's go. All right, the currently low interest rates may have you considering taking on some debt, even in the midst of economic and geopolitical uncertainty. It's the historically low interest rates that even make this perhaps the most opportune time in history to tackle this subject. Opportunities, they abound if you know how to use debt to create wealth. All right, so let's dive in. Oh, by the way, if you're still looking to get that first deal under your belt, I put together a free training just for you to help you get that first deal done, and then how to earn $5,000 a month flipping contracts and properties, working in as little as 1 hour a day. And you can access it at mattsfreetraining.com. In recent years, the word debt has developed something of a bad name or a bad reputation. But the truth is that not all debt is bad. In fact, some types of debt can do you a load of good. And that's to say, I'm not talking about all debt is good. There is a difference. So let's define that first so that you don't make any misinformed and costly mistakes. Whether any given debt is good or bad, it depends on several factors. There's the interest rate and the amount of time it will take you to pay back the loan. Then there's the matter of what you're borrowing the money for. Equally important to consider is your unique tolerance for debt, as taking on debt can be an emotional experience for many. And we don't want to find ourselves in a situation where we're making important decisions based off of our emotions. There's a saying, when emotions rise, intelligence falls. By and large, good debt is borrowing that helps you build long-term wealth. Bad debt, on the other hand, can harm your credit and deplete your finances. So really, good debt makes you money, bad debt costs you money. Credit card debt is probably the most common example of bad debt. The average card balance is over $6,000 per person in the United States. And it's considered to be a form of bad debt because of its high interest rates. But mostly what people use credit cards for is what makes it bad. Dinners out, shopping, vacations, stuff like that. Car loans are examples of bad debt too, because you're taking on debt to buy an asset that depreciates. And even when it comes down to what seems to be necessities, using credit cards to support ongoing living expenses is just not a good use of debt either. Now, on the other hand, student loans are probably the most common example of good debt, given the correlation between a college degree and the higher earnings throughout one's life. However, as of the last decade or so, student loans have gotten a bad rap as a great number of students borrow to fund education in degrees that don't necessarily translate to enough financial rewards to pay the loan back in a reasonable amount of time. So even when it comes to funding an education, whether that be a college education, a trade school, continuing education, self-help, or coaching, the earning potential of the skills acquired through the education needs to be evaluated against the cost of the education to determine whether or not it is a good use of debt. Consider another common example of good debt, taking out a mortgage on a new house. For most people, it's not possible to pay for a house outright. However, even if you were able to pay for it in one large payment, there are benefits to taking on debt for a home. Paying down a mortgage results in equity in a home as well as potential tax advantages. Not to mention the home is a hedge against inflation. And low-rate long-term fixed debt can actually be an asset in a highly inflationary environment, and to a point where it could make sense to refinance periodically to keep the debt in place. Paying off your mortgage, that used to be a badge of honor. And now it's really just a sign that you don't understand how money printing and asset inflation works. Plus, if you continue to make your monthly mortgage payments, there's the additional benefit of improving your credit score. And a good credit score allows you to keep borrowing, getting qualified for better loans, with better terms, with lower rates. And when it comes to big purchases, that savings can amount to be significant. Not to mention, a good credit score gives you flexibility in life, access to better opportunities, and lower insurance premiums. Depending on your circumstances and risk tolerance, leveraged investing can be another good debt strategy. Say you're buying a house for $100,000, and after the first year, your property appreciated 10%. You would have earned $10,000. But if you had invested $20,000 and borrowed the balance, your rate of return would have been 50%, 5 times the return, all because you just borrowed the money. I mean, how much faster could you get wealthy if your returns were multiplied by 5? And all with less risk as well. If you'd like to take a deeper dive into using leverage and building a real estate portfolio, I made a special training on how to do it not 5 times faster, but 10 times faster. How to use debt to build wealth. That's the name of the training. And I'll put a link for you in the description below. Now, debt recycling. This is another good use of debt. And this is where, as you pay off your home loan, you redraw the equity you've built up to invest in another property. You see, what may be perceived as bad debt becomes good debt when it earns you an income and can be used to pay back the loan, as well as providing tax breaks. Any excess income can also be fed back into your home loan to pay that off quicker and make further interest savings. Another debt strategy used by the wealthy involves using a loan to diversify their investment portfolio, especially for certain affluent individuals who hold a concentrated stock position in a single company. You see, they can borrow against that concentrated position to buy other assets, thereby causing their money to work in 2 different places simultaneously. You might have heard me talk about this before as velocity investing. And I actually put together a very popular training on this very thing a while back, the compound interest scam they're not telling you about. And you can find a link for that also in the description below. But first, let me know. If you've got a new idea or two, let me know by smashing the like button. And if you'd like to learn more about creating wealth using debt and real estate, make sure you click the subscribe button because I post valuable trainings like this each and every week and you don't want to miss them. Now, good debt can help you sidestep bad outcomes and even avoid worst case scenarios. For example, a private REI ACE client of mine had a large tax payment coming due last year, April 15th, of course. And this was well before he was expecting a big fat check from one of his flips. And this caused him a serious dilemma. You see, he could have sold off some cash flow properties in his portfolio to pay the tax bill, but that would have required him to eventually pay capital gains tax on those sales, and then he'd have to replace them all later, which would have pushed back his rat race escape another year or 2, at least. So instead, he decided to take out a loan to pay the tax bill, and then he repaid the loan in July when his flip closed. You see, using debt to avoid disruption in your portfolio, that's a really good use of debt as well. Now, I'd be remiss if I didn't point out the risks associated with taking on debt, even if it's good debt. Using debt as part of your investment strategy can introduce substantial risks, including borrowing that could increase potential losses. 2, your losses could exceed the amount initially invested. 3, the value of your investments purchased using debt may not increase, or if the value does increase, it may not be sufficient to cover the cost of the loan, such as the interest rate and the fees. Or 4, you may need to sell your investment sooner than intended to cover your interest, fees, and charges. Or 5, if you're unable to repay your loan, the lender may have the right to confiscate and sell your assets to cover outstanding repayments, interest and fees and stuff, right? And then 6, you may be liable to pay more tax. And all of these are realistic risks, and to a whimsical, uneducated investor, they're more likely than not. So invest in yourself a little bit up front to educate yourself before you take any big leaps into the deep end of debt. Using other people's money, it's a solid path to getting wealthy, if you know what you're doing. Now, if you're inspired by the idea of using debt to create wealth with real estate and harnessing the velocity of money, it might make sense for us to hop on the phone and brainstorm a bit of what that might look like for you. So go ahead, head over to reiace.com, answer a few short questions about yourself and what you'd like to accomplish, and then just pick a time that's convenient for you, for us to hop on the phone and talk about it. That's it for now. Thanks for watching. I'll see you soon.